Let me ask you something that's going to sound simple, but I promise you, the answer changes everything about how you should be thinking about your wealth right now. What happens to your investment when the person on the other side of your trade can't pay you back? Think about that for a second. Your stocks, they're a claim on a company's future earnings. Your bonds, a promise that someone will pay you back with interest. Your bank account, that's just a liability on the bank's balance sheet. Even your real estate, if you really think about it, depends on a functioning legal system to enforce your property rights. Every single one of these investments has what we call counterparty risk. You're depending on someone else to make good on their promise to you. But there's one asset, just one, where you don't need anyone to keep their promise. You don't need a company to stay profitable. You don't need a government to honor its debts. You don't need a bank to stay solvent. You don't even need the legal system to function. And right now, in this exact moment we're living through, that distinction is becoming the most important thing you need to understand about protecting your wealth. I'm talking about physical gold, not gold stocks, not gold ETFs, not gold futures or certificates or any paper claim on gold. I'm talking about the actual metal sitting in your possession or in a vault you control. And what's happening in the markets right now is telling us that the smartest money in the world has figured out exactly why this matters. Let me show you what I mean. In the last 18 months, central banks around the world have purchased over 1,200 tons of gold. That's not just a big number. That's the highest rate of accumulation we've seen since 1950. The People's Bank of China has been buying gold every single month for the past year and a half. The Reserve Bank of India just added another 9 tons. Poland's central bank governor went on record saying they want gold to make up 20% of their reserves. 20%. Now, why would central banks, the institutions that literally create money, be so desperate to own gold? They can print currency whenever they want. They have unlimited access to dollars, euros, yen, whatever they need. So why are they converting that paper into metal at the fastest pace in 70 years? Because they know something that most investors haven't figured out yet. They know that we're entering a period where counterparty risk isn't just a theoretical concern anymore. It's becoming the defining feature of the global financial system. And when counterparty risk becomes systemic, when you can't trust that the promises being made to you will actually be kept, there's only one asset that doesn't require trust at all. Let me take you back to March of 2023. You remember Silicon Valley Bank? Fourth largest bank failure in American history. Happened over a weekend. On Friday, everything looked fine. By Monday morning, the bank was gone. Depositors who thought their money was safe suddenly found out that their bank account was really just an unsecured loan to a financial institution that had made catastrophically bad decisions. Now, most of those depositors got made whole because the government stepped in. But here's what should terrify you about that situation. The government didn't step in because they had to. They stepped in because they chose to. There was no legal requirement to protect deposits above the FDIC limit. They made a policy decision. And policy decisions can go the other way just as easily. What happened next is even more revealing. Within weeks, we saw Credit Suisse collapse. A bank that had survived 2 world wars, the Great Depression, the 2008 financial crisis, gone in a matter of days. And how did they resolve it? They forced a merger with UBS. And in the process, they wiped out $17 billion worth of Credit Suisse bonds. $17 billion of what investors thought were safe, senior securities, just vanished. The bondholders had counterparty risk. They were depending on Credit Suisse to honor its obligations. When the bank failed, their investment failed with it. But you know who didn't lose money in that crisis? The people who owned physical gold. Because gold doesn't have a counterparty. It doesn't depend on any institution staying solvent. It just sits there, holding its value, regardless of what's happening in the banking system. And that's not some abstract historical lesson. That's happening right now, in real time, across the entire global financial system. We're watching the slow-motion unraveling of the post-World War II monetary order. And the institutions that understand this are moving their wealth into the only asset that doesn't require the system to keep functioning. Look at what's happening with government debt. The United States is now $35 trillion in debt. That's trillion with a T. We're adding $1 trillion to that debt every 100 days. Every 100 days. The interest payments alone are now larger than our defense budget. We're spending more money just servicing our debt than we spend on our entire military. Now, if you own U.S. Treasury bonds, you have counterparty risk. You're depending on the U.S. government to tax its citizens enough to pay you back, or to keep finding new buyers for its debt, or ultimately to print the money it needs to make good on those bonds. That's a promise, and increasingly, It's a promise that looks harder and harder to keep. But the people who own gold, they don't need the US government to keep that promise. They don't need any government to keep any promise. The gold just sits there, and it's worth whatever the market says it's worth, completely independent of whether governments can pay their debts or not. This is why we're seeing this absolutely unprecedented divergence between paper gold and physical gold. If you look at the COMEX futures market, you'll see that there are about 100 ounces of paper claims for every 1 ounce of physical gold actually sitting in the warehouse. 100 to 1. That means if even 2% of the people holding paper gold decided they wanted to take delivery of the actual metal, the whole system would collapse. And you know what's fascinating? We're starting to see exactly that happen. In the last 6 months, we've seen record levels of delivery requests on the COMEX. People are saying, I don't want a promise that you'll give me gold. I don't want a certificate that says I own gold. I want the actual metal, because they're figuring out that the paper claim has counterparty risk and the physical metal doesn't. Let me tell you a story that perfectly illustrates why this matters. In 2011, MF Global, a major commodities brokerage firm, went bankrupt. They had billions of dollars in customer assets. Farmers who had hedged their crops, investors who owned gold futures, all kinds of people who thought their money was safe in segregated accounts at this brokerage. When the firm collapsed, they discovered that MF Global had been using customer funds to make its own proprietary bets. The money that was supposed to be safely segregated was gone. It took years of litigation for customers to get most of their money back, and some of them never got fully made whole. But here's the kicker. Some of those customers had actually taken delivery of physical gold and stored it in MF Global's vaults. And you know what happened to them? Nothing. Their gold was sitting in the vault. It wasn't part of the bankruptcy estate. It wasn't tied up in litigation. It was their gold, physically separated from the firm's assets, and they just took it and walked away. That's the difference between counterparty risk and no counterparty risk. The people who owned paper claims on gold had to fight for years to get their money back. The people who owned physical gold just picked it up and left. Now, I know what some of you are thinking. You're thinking, okay, but I'm not worried about my brokerage firm going bankrupt. I'm not worried about the banking system collapsing. That's extreme scenario thinking. And maybe you're right. Maybe the system holds together just fine, and none of these risks ever materialize. But let me ask you this. What's the cost of being wrong? If you're right, and the system holds together, and you own some physical gold, what have you lost? Gold has been going up in value anyway. It's up over 30% in the last year. It's hitting all-time highs in every major currency. So even in the scenario where nothing goes wrong, you're not losing money by owning gold. But if you're wrong, if we do see a major financial crisis, if we do see bank failures or currency problems or sovereign debt defaults, and all you own is paper assets with counterparty risk, what happens to your wealth then? You could lose everything. Everything. That's an asymmetric bet. The downside of owning gold is minimal. The downside of not owning gold could be catastrophic. And the smartest investors in the world, the ones managing billions and billions of dollars, they understand this math perfectly. Quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties, how the storage works, what the costs are, all of that. Worth checking out if you're thinking about this stuff. Anyway, back to what's happening in the markets. Let's talk about what's happening with the dollar, because this is where counterparty risk becomes really obvious. The US dollar is the world's reserve currency. That means when countries trade with each other, they usually do it in dollars. When central banks hold reserves, they usually hold them in dollars. The entire global financial system is built on the assumption that the dollar is stable and trustworthy. But what is the dollar really? It's a liability of the Federal Reserve. It's a promise that the US government will maintain the dollar's value. That's counterparty risk. You're trusting the US government to manage its currency responsibly. And right now, we're seeing countries around the world decide that maybe they don't want to take that risk anymore. The BRICS nations, Brazil, Russia, India, China, South Africa, they're actively working on creating alternative payment systems that don't use the dollar. Saudi Arabia, which has priced oil in dollars for the last 50 years, is now accepting yuan for oil sales to China. The United Arab Emirates is settling trade in rupees and dirhams. This is called de-dollarization, and it's accelerating. And every time a country moves away from the dollar, they're essentially saying, we don't want to hold our wealth in an asset that depends on the US government keeping its promises. We want something else. And what are they buying instead? Gold. Massive amounts of gold. Because gold doesn't care about U.S. monetary policy. It doesn't care about inflation or interest rates or government debt. It just sits there, holding value, with zero counterparty risk. Let me give you another example of how this plays out in practice. In 2013, Cyprus had a banking crisis. The government was broke, the banks were insolvent, and they needed a bailout from the European Union. But the EU said, "We'll give you the money, but you have to bail in your depositors. You have to take money directly from people's bank accounts to recapitalize the banks." And that's exactly what they did. If you had more than 100,000 euros in a Cypriot bank, the government just took a percentage of your money, didn't ask permission, didn't give you a choice, just reached into your account and took it. Now, those depositors thought their money was safe. They thought a bank account was a safe place to store wealth. But what they learned is that a bank account is really just an unsecured loan to a bank, and when the bank gets in trouble, you're just another creditor. You have counterparty risk. But the people in Cyprus who owned physical gold, the government couldn't touch it. It wasn't in the banking system. It wasn't on anyone's balance sheet. It was just metal, sitting in a safe deposit box or a home safe, completely outside the reach of the bail-in. This isn't ancient history. This happened 12 years ago in a developed European country. And the precedent it set is terrifying. Because now we know that when governments get desperate enough, they will absolutely confiscate wealth from their own citizens to keep the system running. And the only wealth they can't confiscate is wealth that exists outside the system. Now, let's talk about what's happening with inflation, because this is another form of counterparty risk that people don't think about enough. When you hold cash or bonds or any fixed income investment, you're depending on the government to maintain the purchasing power of the currency. That's a promise. And it's a promise that governments break constantly. The official inflation numbers say we've had about 20% cumulative inflation over the last 4 years. But if you actually go to the grocery store or try to buy a car or pay for healthcare, you know that number is nonsense. Real inflation, the inflation you experience in your daily life, has been much higher than that. And every bit of that inflation is a broken promise. The government promised that the dollar would hold its value. They broke that promise. And if you were holding cash or bonds, you lost purchasing power. You had counterparty risk, and the counterparty didn't keep their end of the deal. But gold? Gold doesn't make promises about purchasing power. It just reflects what the market thinks it's worth. And over time, over long periods of time, gold maintains purchasing power incredibly well. An ounce of gold bought roughly the same amount of goods and services in 1920 as it does today. The dollar has lost 99% of its purchasing power in that same period. That's the difference between an asset with counterparty risk and an asset without it. The dollar depends on the government keeping its promise. Gold doesn't depend on anyone keeping any promise. Let me tell you about what happened in 1971, because this is when the modern financial system was created, and understanding this history is crucial to understanding where we are now. In 1971, President Nixon closed the gold window. Up until that point, foreign governments could exchange their dollars for gold at a fixed rate. The dollar was backed by gold. It was a promise that the U.S. government kept. But by 1971, the U.S. had printed so many dollars to fund the Vietnam War and the Great Society programs that foreign governments started demanding gold in massive quantities. France famously sent a warship to New York to pick up its gold, and the U.S. government realized they couldn't keep the promise anymore. They didn't have enough gold to back all the dollars they'd printed, so Nixon just broke the promise. He said no more gold backing. The dollar is now a pure fiat currency, backed by nothing except trust in the U.S. government. And you know what happened to gold after that? It went from $35 an ounce to over $800 an ounce by 1980. It increased in value by more than 20 times in less than a decade, because the market understood that once you remove the gold backing, once you make the currency purely dependent on government promises, you've introduced massive counterparty risk into the system. We're living through a similar moment right now. The promises that underpin the global financial system are becoming harder and harder to keep. Government debt is exploding. Central banks are printing money at unprecedented rates. The banking system is fragile, and the people who understand this are moving their wealth into the one asset that doesn't require any promises to be kept. Look at what's happening with gold mining stocks versus physical gold. Normally, gold mining stocks move in the same direction as gold prices, but with more volatility. When gold goes up 10%, mining stocks might go up 20 or 30%. That's the leverage you get from owning the companies that produce gold. But right now, we're seeing something strange. Gold is hitting all-time highs, But gold mining stocks are barely moving. They're underperforming physical gold by a massive margin. Why? Because mining stocks have counterparty risk. You're depending on the company to manage its operations well, to not get nationalized by a foreign government, to not get hit with unexpected taxes or regulations. Physical gold has none of those risks. The market is telling us that investors want the asset with zero counterparty risk, not the leveraged bet on that asset. They want the thing itself, not a claim on the thing. And this is showing up in premiums for physical gold. If you go try to buy gold coins or bars right now, you're going to pay a significant premium over the spot price. That premium has been widening for months. Why? Because there's more demand for physical gold than there is supply. People want the actual metal, not paper promises. The US Mint has been rationing gold and silver coins because they can't keep up with demand. Dealers are running low on inventory. Delivery times are stretching out. This is what happens when people start to understand the difference between counterparty risk and no counterparty risk. They want the real thing. Let me give you one more historical example because I think this really drives the point home. In 1933, President Roosevelt issued Executive Order 6102, which required all Americans to turn in their gold to the government. It was literally illegal to own gold. The government confiscated it, paid people $35 an ounce for it, and then immediately revalued gold to $35 an ounce. Now, why did they do this? Because the government needed to devalue the dollar to get out of the Great Depression. But they couldn't do that while the dollar was backed by gold. So they confiscated the gold first, then devalued the currency. The people who had their wealth in bank accounts or bonds or stocks, they all lost purchasing power when the dollar was devalued. But the people who had hidden their gold, who had kept it outside the system, they preserved their wealth. They had an asset with no counterparty risk, and even the government couldn't fully take that away from them. Now, I'm not saying we're going to see gold confiscation again. The circumstances are different now, but I am saying that when governments get desperate, they will do desperate things. And the only wealth that's truly safe from government action is wealth that exists outside the system. This is why we're seeing such incredible demand for physical gold right now. It's not just about price appreciation, though gold has been appreciating nicely. It's about safety. It's about having an asset that doesn't depend on anyone keeping their promises. It's about eliminating counterparty risk from your portfolio. And the timing of this couldn't be more important. We're at a moment in history where the risks in the financial system are higher than they've been in decades. Government debt is at levels we've never seen before in peacetime. The banking system is more concentrated and more fragile than ever. Geopolitical tensions are rising. The dollar's role as reserve currency is being challenged. Any one of these risks could trigger a major financial crisis. And in a crisis, counterparty risk becomes the thing that destroys wealth. The promises that seemed solid suddenly aren't solid anymore. The institutions you trusted suddenly can't be trusted. And if all your wealth is tied up in assets that depend on those promises and those institutions, you're in serious trouble. But if you own physical gold, you're outside that system. You have an asset that doesn't need the system to function. You have wealth that's truly yours, not dependent on anyone else keeping their word. This is why central banks are buying gold at record rates. This is why wealthy families are moving significant portions of their portfolios into physical precious metals. This is why we're seeing premiums on physical gold widen and delivery times stretch out. The smart money understands what's coming, and they're positioning themselves accordingly. The question you need to ask yourself is this: how much of your wealth are you comfortable having exposed to counterparty risk? How much are you willing to bet that all the promises being made to you will actually be kept? How much do you trust that the system will hold together exactly as it is right now? Because if your answer is anything less than 100% certainty, then you need to own some physical gold. Not gold stocks, not gold ETFs, not certificates or futures or any paper claim. The actual metal in your possession or in a vault you control. That's the only investment with zero counterparty risk. That's the only asset that doesn't require anyone to keep their promises. And in the world we're living in right now, that might be the most valuable characteristic any investment can have.